Kyle Smith, and this week I sat down for a morning meeting with Vice President and Wealth Advisor of WWM Financial Greg Carroll. Greg started his own firm back in 2008 at the height of the Great Recession and shares some similarities that he's seeing today. Listen in to find out what he says we can do about it. Hope you guys enjoy it. All right, hey Greg, welcome to the bullpen. Thanks for meeting me.
Hi, Kyle. Thank you for having me. And I just want to say thank you to all the first responders out there. We appreciate everything that you guys do, especially in this environment. There's a lot of crazy stuff going on out there. So it's more important than ever to have you guys out there. So I think the majority of us are still with you guys.
Well, I appreciate you saying that. It's important for our guys to hear that, to maintain their spirits up, because it has been a trying time for everyone. And yeah, I do appreciate you saying that. You are friends with one of our firefighters, Rich Marcel. He said I had to interview Greg. Get Greg on the line, and you'll have a lot of great information to share with us. So I'm really excited to just have a conversation and see where things go. That sound reasonable?
Sounds great.
Cool. Well, good. So I'm just going to fill you in on how we do things here at the San Diego Fire Department. For us, a first alarm would include 4 engines and a truck, but your first alarm will be, I ask you 4 questions. You give me 1 piece of advice. Okay?
Okay.
All right. Well, cool. So here comes your first alarm. Well, you're going to be first in on your first alarm. So when you're first in, you have to give a size up, and your size up is who you are, where you work, and how long you've been doing it.
Okay. Well, my name is Greg Carroll again. I work at WWM Financial up here in Carlsbad, very near the airport. And I've been in the business now for a little over 25 years.
That's great. What got you into the financial services industry? Was that always an interest for you, or is that something that kind of came along?
It wasn't. And it wasn't until my father taught me how to have a good work ethic and make sure I always had jobs since the time I could walk. So I always had an affinity for money. And when I found out right around when I started college that there was a way for my money to work as hard as I do, and I could have that working for me, it became an interest. And so I started playing around with a few stocks, and then, that was kind of the catalyst. And then by the end of college, I was, searching out positions in the industry. So
that's cool. So for us on the fire department, we're all W-2 employees. So we receive a paycheck every 2 weeks. We do like the security of that, but we don't have our money working for us just off the back. Do you mind just expanding on that and explaining what having your money work for you really means?
Well, I think that, especially in this day and age, we all know that if you look at your bank account statement, your savings account, you could have $100,000 in there. That's going to make you about a nickel a year. So we're in an extremely low interest rate environment where you could have put your money in a bank, decades ago and made a little bit of interest in a very safe manner. It's just not the case anymore. So, by investing, having a methodology to invest, or maybe having an advisor on your side to help you invest, you can actually see your money starting to work and grow along with your contributions. So you kind of get a compounding of the returns in 2 ways. Your contributions plus the money that's in there is working harder for you. And you start out with good, solid blue chip companies, names that you use every day, AT&T, it could be a retail store, Amazon, Apple, anything like that. But just getting your feet wet in the beginning, taking it slow, you'll find that over time, your money can really work hard for you as well.
Oh, that makes perfect sense. Investing in things that you understand and easily are recognizable, instead of sort of these really fancy products that might be over your head. I really like that. Simple, but sometimes not easy.
Right.
I guess, so over the last couple of decades, having been involved in the financial services industry or wealth management industry, there has to have been some things you maybe aren't proud of, but had made mistakes in the past, or maybe some things that you see other advisors, other advice that they're giving that really doesn't sit well for you. Is there anything that sticks out that you hear other advisors saying that really doesn't make sense to you?
When I started in the business back in the mid 90s, I started with a firm called Solomon Smith Barney, which is now been incorporated or merged into Morgan Stanley. the large brokerage houses or the large banks is where a lot of advisors get their start. They have a lot of great tools. They have a lot of great training. They give you a good leg up in the business, but they're very controlling as far as the ability to invest in certain ways for individuals. Not everybody is the same. Not everybody needs the same portfolio, the same companies, or the same products. So we found after a number of years that being in that environment, and there was a few circumstances where we just knew that we, as what they call retail advisors, and our clients were not the first priority. And we kind of got the short end of the stick a few times. So about 10, 12 years into the business, I had two partners of mine, and we decided to go off and start our own financial services business in what they call the independent side of the business, or a registered investment advisor. So in the main difference between those two worlds, the big brokerage houses and the RIA world, is the brokerage business, they have to put, if they're offering you a product or an investment, it has to be suitable. So based on your age and circumstances, if it kind of makes sense in and of itself, not in the big picture, but that one investment, they can do that. And they usually charge commissions. In the RIA world, we're held to a fiduciary standard. So we can't charge commissions, first of all. And secondarily, we have to, if the investment is not in your best interest, we can't do it. If there's any conflict of interest, we can't do it. So and there's a lot of great people in those big firms, but they're just, the world's not completely transparent, I should say. And so I'd be very careful anytime you talk to an advisor, dig around a little bit and ask them, questions that, why this and not that? Are there conflicts of interest? You can ask that.
Is it fair
are you a fiduciary? That's a very important one.
Yeah. Is it fair to ask that? Are you a fiduciary? How are you being compensated? What's my bottom line here? Is it a fair question to ask?
Absolutely. Okay. Absolutely.
Okay. Yeah, it's interesting. And I like the part you're talking about, that there's no one size fits all for people going down the path towards financial independence. It's, personal finance being very personal. And I think if you try to just lump everybody together, give them whatever product over here that is going to earn you the highest commission, it is a conflict of interest, and it doesn't really serve the client very well. So yeah.
Right.
You kind of mentioned earlier the state of the economy and where we are, interest rates being rock bottom. How does the economy affect first responders, you think? What sort of things should we be looking out for, and are there any similarities in today's world versus sort of 2008 or so? Are you seeing any parallels or things that we can be aware of?
One of the, I was trying to, think about that earlier. And to me, the municipality that you work for is your boss, it's your company. And one thing that I would be very involved in if I was in your position is, in the budgeting process, be involved in the union negotiations, understand what's going on with the city budgets, because when we get into situations like this, or 2008, 2008 was the Great Recession, which was the worst recession since the Great Depression. We spent a lot of money as a government to get us out of that. Well, we dwarfed the amount of money we spent over the last 10 years in a matter of weeks. And we've multiplied that, and we're not done spending money on it yet. So at some point, someone's got to pay for this. And so it's going to be higher taxes. Budgets are going to be examined for any way that they can reduce costs. So you got to look at, benefits, future salaries, job cuts, layoffs, things like that. I think you just want to be aware of that. I'm not predicting that, but, I find in my experiences that a lot of people, not just in your line of work, they just aren't prepared for a financial hardship. And so having a savings in place, having a plan and money that is set aside, unlike the government sets money aside for Social Security, but then they go spend it on something else. Don't do that. Have that money set aside. 6 months is a good rule of thumb, but the more the better. And put it in a lockbox. Be prepared. Be ready. I mean, you guys know you got to be prepared all the time for any event.
Yeah, it's interesting you say that, Greg, because we set up safety systems, contingencies upon contingencies when we're out there running calls trying to help people. And so many of us don't have that little emergency fund to help rescue ourselves if things go really bad, like we saw in 2008. I'll link to a video I did on an emergency fund and how to build that and what that means and just how important it is. And again, the more people I talk to about this sort of stuff, the fundamentals are the same. It's very simple, but it's not easy. It takes a little bit of discipline. It takes a little bit of executing on the basics of saving some money, investing what you can, and then having that emergency fund socked away that's going to prevent you from having to put some expense on a credit card or something where you'd be paying this huge amount of interest. So yeah, I really like that. Looking back, Greg, is there a mistake that you've made in your own financial life or your own investing career that you actually are happy that you made because of that it helped you grow, or it helped you learn something, or you were able to pass on that information to someone else?
Being a financial advisor and going through the training that we do, early in my career, I thought I was smarter than I was, and the market continues to teach you. I'm going on 26 years now, and it's always something new. So, you've got to be, when you're investing, you want to be consistent about it. You want to keep adding money on a consistent basis, kind of like you might be doing to a retirement plan. And kind of what that does is it allows you to, buy a certain investment, say a mutual fund. If you put $100 a month into it, it's okay if it fluctuates, because when the price goes up and that day comes to buy it, you buy it. You just buy less shares of it because it's higher. But maybe the next month or several months down the road, it might have taken a dip. And so what you do is you buy more shares for that $100. Over time, it's called dollar cost averaging, and you'll get a better than average cost. And so you want to be consistent. You want to know how much you're risking and what it's for. So you want to know how long the investment is. Is it for, a vacation, a new home? Maybe it's your retirement account. You want to define that. You want to know what the exit strategy is. So, and the biggest thing is don't get emotional. If you have a plan, if you're disciplined, just like in your job, you come up against a big fire or explosion or something, if you guys get emotional, you make some bad decisions. You kind of activate that, smaller part of our brain is very primitive, but it's very powerful. And when you get your emotions in front of the decision-making process, we activate this fight or flight, which is, ingrained in all of us, going back to the Stone Age. So all, reality and processes go out the window. So you just, it's not a good situation. Most people will sell at the bottom of the stock market, and most people get in at the top.
Mm-hmm. It's the opposite of what you are supposed to do.
Exactly. On the top, it's FOMO, your fear of missing out, because all your buddies are talking about, what stock is doing this or that, and you don't know much about it. If they're talking about it, it's already done some great things. It doesn't mean it's going to continue. So be disciplined.
By the time that information trickles down to us, absolutely everybody knows about it, and it's it's an efficient market. So there's no margin there for you to get. So I always am amazed by that psychology of investing. It's like we're motivated by fear and greed. And
we are.
Things cause you to sell at a bottom and buy at the top. It's incredible. And you talked about having a plan, and don't panic sell, or don't let your emotions come into it. We have a thing on the fire department called freelancing, and that's where you just go off and do your own thing. You totally abandon the plan, and you go over here and try to solve the problem on your own, and inevitably it leads to disaster, and it's strictly forbidden. So I think this is where your company would come into play, where you could help somebody formulate a plan, help them stick to it, some percentage of their income dedicated to investing each month, that aligns with their retirement goals, their investment goals, their risk tolerance. But then the other side of that is helping keep them accountable and helping keep them from panicking and freelancing and blowing the whole thing.
Yeah, all you have to do is, when you think you want to make some big alteration to your investment plan, is look at some of the long-term charts, whatever it is you're investing in, a mutual fund or the S&P 500. Some of the best client experiences I've had have been the ones that I have tinkered with the least and kept that long-term plan in place and not tried to, maneuver too much, because there's a lot of times it's some sort of emotional effect that's causing that, and it's usually the wrong decision. So, stay the course and be disciplined.
Yeah, there was some study done where they took a sample of investors and saw what their returns were over some period of time, and one of the groups that fared the best didn't tinker with it with their portfolios at all, and that's because they had been dead for the last 5 years or whatever. So I think that's interesting you say that. But yeah, just circling back, if somebody was dead set on learning more about this but doing it on their own, what is a resource or a set of resources that they absolutely need to be aware of?
This current market environment is a little bit unique, but it's a very high momentum type market. Some of the valuations don't necessarily make sense. Maybe they do. We are kind of in a new world with this lockdown, and a lot of things are changing. But reading Benjamin Graham or Warren Buffett, read any of their books, they will get you on the ground floor understanding what you're looking for in a stock. What is a true value of a stock? You're looking at the earnings per share, the cash flows, the reinvestment of their cash flows, the dividends they pay out, the sustainability and the increasing those dividends over years. So it really gives you a good foundation. And there might be a lot of pundits out there these days that go, well, value investing is dead. It's not dead. It's just taking a break. But to truly understand investing and not just buying the hot dot that's on CNBC or the news, that's understanding. And the more you understand, the more comfortable you are. That's why you guys train. You practice. You understand it. You're more comfortable. It's not that hard. But if you're just buying names because everybody else is there doing that, it usually ends in disaster.
Yeah, no, that's perfect. And for those that don't know, Benjamin Graham is the author of The Intelligent Investor and widely considered the godfather of value investing. Burton Malkiel would be another person that I would sort of lump in that category. He's professor of economics at Princeton, and his book, The Random Walk Down Wall Street, all talking about understanding the fundamentals. Does the company that you're interested in investing in, do they tick the boxes of being a great company itself? Not just because the guy down the street or the guy sitting at the fire station says it's a great company. No, what are the actual fundamentals of the company that you're thinking about investing? Right. So I think that's perfect. Now you mentioned index funds and mutual funds. Those are similar. They may be cousins or something. Can you just identify some of the distinctions between the two?
Between a mutual fund and an index fund?
Yeah.
Okay. A mutual fund and some index funds are structured the same way. Basically, an index fund is unmanaged compared to a typical mutual fund, but the way they both operate is there's a portfolio of stocks inside of that wrapper, the mutual fund wrapper. And you buy and sell those at the closing price of the day. At the end of the day, all the stocks are added up, and that's the price you're basically paying for it per share. The index is like the S&P 500, which is your large blue chip type companies. A lot of names you're more familiar with. There's a Russell 2000 index, which is the smaller companies on the stock exchange. You're probably not as familiar with most of those names. A lot of there's a lot of debate over the years is active management, where you've got a mutual fund manager buying and selling those stocks inside of there, or buying these indexes. There's been a lot of debate which way is better. I think sometimes, combination of both. But I think when you really get into an environment like you're in now with the economy, have an active management and a manager that has a manageable number of positions in there. The S&P 500 might have 500 stocks, or it does have right about 500. A manager that invests in large capitalization stocks, similar to that. I prefer one that might have 30 to 50 stocks. He can hone in and find the cream of the crop, because when you buy $1 of the S&P 500, every stock in there gets a piece of that dollar. So there's a lot of companies in there that maybe don't deserve any of your money, but they're getting a piece of it. And so right now there's about 5 stocks contributing to the majority of the move in the last, especially year to date, and especially even more so since the bottom of the market in March. So when you've got leadership that narrow on a big index, you just want to be very careful.
I think I saw it's about 23% in about 5 companies that you're saying is weighting the S&P, and it's the Facebooks and the Googles and some of those large companies, but it is heavily weighted that way. So it's interesting you say that. Now, how does an ETF play into all that? That's a little bit different, where you can trade it during the day. Do I have that right?
Correct. So yeah, the ETF was a more, it's not as old as mutual funds, but it trades like a stock. You buy and sell it throughout the day during the market hours. And it could be of the same portfolio as an index fund or an actively managed fund. But you have that ability to trade in and out throughout the day, instead of just trading at the end of the day.
Okay. Yeah, that makes sense. And I guess you get a little bit of the diversification with an ETF, but also the flexibility of trading throughout the day. Maybe you see it dip a little bit, and that would be a time to jump in.
Yeah, and I think in the ETF market, they can get a little more specialized, so they can really break down some of these larger indices into some very small subgroups. That normally wouldn't make sense to do a full mutual fund. The assets under management don't have to be quite as large, and so it allows you to really pinpoint certain areas of an economy if you so choose. If you're that motivated to get that granular, you can do that with ETFs.
Somebody who had the foresight to look at a tech ETF or something probably would have done really well over the last several months, I imagine.
Yeah, a good one of my favorite all times is the QQQs. Mm-hmm. There's a lot of stocks out there. Everyone wants to buy Tesla or Apple or Microsoft or Amazon. They're all in there. Buy the Qs. You get you're going to get right around 100 stocks in there. They're all technology oriented. Starbucks is in there. You said, well, that's not a technology company. Well, they actually are. They're very technology oriented. McDonald's is becoming very technology oriented about their service. They're not in there at this point, but you'll find a variety of companies, not just those big 5 or 6 that seem to be doing all the pushing or heavy lifting of the indices this year.
Oh, that's perfect. Well, I told you at the beginning I would be asking you 4 questions and you'd be giving us 1 piece of advice, but I took full advantage and asked you way more than that, so I do appreciate that. And with that, Greg, it looks like you got knocked down on your first alarm.
Well, thank you. I appreciate it.
Yeah, you bet. So, Greg, if people are looking to learn more about you or interested in finding more out about maybe just how to improve a little bit at the margins, where could they find you?
They can find me at WWM Financial here in Carlsbad. You can also catch me at Greg, Greg, at WWMFinancial.com is my email. Also, I'm on LinkedIn, Greg Carroll. And, anytime you want to ask a question, I'm happy to answer. Part of being in the business this long is, sharing some of the knowledge to people that there's so many mistakes that can be made out there. So if you ever have questions, there's never one that shouldn't be asked. And I would love to be a resource.
That's perfect. Well, I'll make sure I link all those in the show notes. And yeah, I want to just thank you again for your time today. There was a ton of information here to digest and unpack. And yeah, I just appreciate your time. Thanks, Greg.
Kyle, appreciate it. Nice meeting you.
All right, thanks again to Greg for meeting me here in the bullpen. His advice about making your money work for you by investing on a regular schedule through dollar cost averaging is just perfect in this economic climate with so much volatility. If you'd like to learn more about Greg, you can find him on LinkedIn at Greg Carroll, or you can email him at greg@wwmfinancial.com. If you'd like to learn more about us, we're on Facebook at The FIREhouse. That's f.i.r.e.house. On Instagram, the _fire_house. On LinkedIn, the FIREhouse Investors, or any place you listen to podcasts. If you learned something today and you'd like to hear more, please like, share, and subscribe. But no matter what you do, take this information, go out there, and get some. Station F.